What you can see on the chart here is an uptrend using the concepts of market structure and demand zones that we just spoke about. The trend starts here. We have an higher high, higher low retesting demand. So there would be a nice buy trade there. Then we stall out here and then we break up. So this is the zone that broke structure. Then from here, we have a higher high and we have what looks like a higher low, which forms a new demand zone. Which zone do you think you should focus on really here? Now, it can be tempting to go with this one, and that is not entirely wrong. A lot of the time, this zone will work out. However, I've found more of the time, the zone below is going to work out because it is an imbalanced zone. Now, this is the concept we're going to be talking about in this video, market efficiency. I don't expect you to know what an imbalance is or what market efficiency is right now, but I'm just showing you an example of what it looks like before we start digging into it. Now, as we see, most of the time, supply and demand zones are retested. When we get a movement like this, the market comes in and retests this area before moving up. When we do something like this and form a demand zone, and then we move away and we form a new demand zone without retesting this one, it's very common that we'll actually see price push through the first zone, like so, and actually drive into that untested demand zone. And that is due to something called market inefficiency. So in this video, we're going to talk through market inefficiency, what it is. I'll show you some real life examples, and I'll explain how it comes into our trading in line with supply and demand and in line with market structure. When it comes to market efficiency, there are two phases a market can be in. There is efficient price action and there is inefficient price action. Efficient price action is like what we've been speaking about, where the market moves away from a zone and then comes all the way back and retests it. This is the cleanest and easiest price action to work with, and it's what's going to happen a lot of the time. However, also quite common is inefficient price action. This is where the market is going to form a demand zone or supply zone, move away, and then fail to retest. And what that does is leave open an area in price, which is known as inefficient pricing. When these moves happen, it's usually because of an injection of buying pressure that happens above the demand zone. But the markets move based on orders. The markets continually move back and forth, collecting buying and selling orders to fuel that battle between buyers and sellers. So if we have, for example, a large amount of buying orders in this area, and there's not so many buying orders here, when the sellers begin selling into the market, what that's going to do is push it down. And if there's no buying orders until this point, it's going to drag all the way through until we hit that point. Now, that doesn't actually mean that we've broken the trend, so to speak, which is why that this concept is important, because it can be very confusing in this, right? Because what we actually then see is all of those buy orders collected and the market begin to move back up again. So this is quite a tricky concept when you're trying to get your head around supply and demand and market structure, because this kind of goes against that market structure. But it does make a lot of sense, and throughout the course you will learn how to use this concept and how it works. So the best thing to keep in mind right now, before we start getting into this a little bit more, is why this happens. Efficient price action happens because the market has come to collect those orders and there's no injection of buying orders higher up. So we can simply move efficiently, move from the buying pressure, pull back in, collect more buying pressure, and then move back up. Inefficient price action actually leaves a gap open, and then when the buyers lose their strength, there are no buy orders waiting or no significant buy orders waiting until that demand zone. So we get a push down, which will actually wipe out a lot of traders who are buying at these levels, push into that imbalanced zone, and then begin making a move up from there. So when you understand the concept of efficient and inefficient pricing, you can actually use it in your trading in two ways. Obviously, first of all, to trade nice, steady, efficient trades. And second of all, to avoid losses when the market is inefficient, and also to find some great entries for trades. And you can even use the inefficiencies for targets. So what we're going to do now is show you some market inefficiency examples in scenarios that I've actually traded myself. Starting from the top, we're going to bring the structure and we're going to bring the supply and demand into this as well. And we can see that we are really in a swing structure downtrend. If we just zoom out a little bit, we can see the market is forming lower lows and lower highs, lower lows and lower highs, lower lows, and potentially a lower high on this movement here. Okay, so if we keep in mind what we said on the structure episode, we have the impulse, we have the correction. Within the correction is substructure. So the swing structure is this large downside move, and then we have a substructure uptrend. Okay, so what we're looking for is basically price to come into a meaningful area to then form the next leg of swing structure, which is going to drive the market down. So now then, bringing the supply into it, Well, we can look here, we can see the zone that broke structure is this zone here, okay? So this is obviously the area we want to focus on because we've had the breaks of structure from this area, and even the previous leg here was formed by this supply zone. So this is the supply zone that we'd look to sell from, and as we know, we could potentially trade this through into the swing structure area using this bullish substructure, okay? So let me just box this off, and we'll keep that boxed off so you can see the swing structure and the substructure separated. This marks the substructure. And now from this point, this is where the imbalances really come in, the inefficiency really comes in. So looking at this market then, we know we want to sell, okay? We have a swing downtrend and we have a good supply zone to actually look to sell from. All we need to do is see the supply zone retested. But as we can see, it hasn't yet been retested. And while the market has actually formed this high, and then a lower high, and then another lower high, it has failed to fill this zone. So whereas many traders may see this, and I'm not sure if you're familiar with basic retail concepts, but if you are, you may know what a triple top is. Many people would see this as a triple top, or a series of slightly lower highs, and they'd start selling here. The thing is, we don't want to do that because we know now, from the example I just showed you on the diagram, is that this market is not efficient yet. We have an open space in price here, leading us into a supply zone. So we can mark that on with this IMB. Now I got you to set that up earlier. What this stands for is imbalance. And an imbalance is basically an inefficient price area. It's just another name for it that I use. Now that we know the market is imbalanced and we still have some space to fill before moving into the supply zone where we want to sell, we can actually avoid taking a loss by not selling here, okay? We expect that even if the market does push down a little bit, it's probably then going to come and push back up into this area before the big sell-off occurs. So now I'm going to zoom in a little bit to the hourly time frame, and we can keep in mind that we do want to sell this market, but we don't want to do it yet until this area has been filled. So what we can actually consider from here is trading with the substructure, okay? If we know we still have room to the upside, we could look to buy the substructure and take it into the swing zone. So what we can then do is have a look at the supply and demand zones. What did we speak about in the previous video? The zone that broke structure is the zone we want to see. Well, the last significant break of structure in the trend was here. So we could look at this zone that broke structure and keep this in mind for a buy. Now, what we could also do is look a little bit lower down because what we can see is imbalance. Okay, we have this open price area bringing us into another zone down here. So it's always worth keeping this one in mind because it's imbalanced. So if we think about what we just said, we get a push away and then the market comes and forms a new demand zone, but it doesn't retest the previous one. And then we get another push away. Many times the market is going to come into that low zone and actually give us an opportunity to buy from there. So which zone do you think we should be focusing on for buy? Well, the simple answer here is both. We should look towards both zones and then wait for price to hit them and see what we can do from there. Okay, there's no point being too picky. Normally we will go for the zone that broke structure, but when we have a large imbalanced price area like this underneath, what we would look to do instead is just wait for price to trade into it. And if the market does start taking off, we can then get an entry from this point. And if it doesn't start taking off and it slams straight through, we can look towards this point for an entry instead. So allowing the market to do its thing then, what do we see? We see a big sell-off. Price goes straight through the zone that broke structure because it needs to come and fill this imbalanced area. It needs to come and fill through the inefficiency and collect the buy orders that are sitting in this zone. So what we could then do is look to actually buy it from that bottom zone. So that is an example of imbalance there. And this is an imbalanced zone. And this is actually a trade I took myself from 840 with a 10 pip stop loss and a target into the imbalanced zone. So see how this trade has been pretty much entirely formulated using those concepts of imbalance, structure, and supply and demand. We obviously know the high time frame structure is bearish and we have a high time frame bias to sell the market, but we can then see that this substructure move is bullish and we have imbalance open into the top and we have now an imbalance open into this zone that we can look to buy from. So what we can actually look to do is like a buy into a sell, and we could actually look to buy it to then sell it like so. Okay, we can buy through into that zone and then sell from that zone when the imbalance is filled. And if we actually just leave the market to do its thing, you will see that my buy was triggered very, very precisely because the imbalance was finally filled. We collected the buy orders and we shot up. Now, why did we shoot up with so much strength? That is because the buy orders were collected from this zone. So notice how I said the reason the market fills imbalances is to collect buying and selling orders. Well, it made this large movement after tapping that zone because all of the buy orders that were waiting, that were imbalanced, that were in this zone have just been collected. So the market has a lot of strength and a lot of buying pressure to move to the upside. Now, from that point then, the market was actually triggered in and it started selling off. And we can see that the market sold off very, very nicely to a very, very profitable and successful trade both ways. So there was a wonderful buy and a wonderful sell. And you can see that all of it came about from that imbalance and that market efficiency. Before the market could make a large move down, it needed to collect the sell orders in this zone. So this was just not a good place to sell from. But before the market could actually move up to this area, it needed to collect the buy orders in this zone. So when the market came down and traded into this zone, we saw all of the buy orders there push into the market, drive us up, fill the other imbalance, and then all of the selling that was waiting in this swing area has came in and drove the market down. So that is how imbalances and market efficiency works. Basically, what we're looking for is open price gaps like this, where we have a supply zone or a demand zone and then a large sell-off. And when we see a large price gap that's left open after a supply or demand zone, we can expect that to be filled before the buying or selling orders are collected to make the next leg of movement in the market. And that is how we trade market efficiency. So as you can see, I'm kind of step-by-stepping each of these processes into each other. The thing that I teach here, which is what a lot of people fail to teach, is a system. I'm not just going to give you information and leave you to work it out on your own. I want to show you an actual trading system that you can follow step by step. So you'll notice throughout the whole course that all of the concepts come together. In this instance, I've just showed you an entire trade breakdown using imbalance, using supply and demand, and using structure. It goes deeper than this, and we will have a lot of information on applying these trades to the timeframes so that you can work it out yourselves. But for now, we're going to continue on through the processes. And what I'm going to do in the next video is introduce the concept of liquidity.